Okay, so you've been following the stock market and you're a little, concerned about this dip we've been seeing.
Yeah, it's definitely been noticeable.
It has, and you want to know more about it.
Yeah, for sure.
Well, that's exactly what we're doing today. We're going to take all the information you gave us and really just break down this recent downturn in the market.
Definitely.
And we want to do it in a way that's quick,
Yeah.
it doesn't take too long,
Right.
but also gets you all the information you need to, feel like you really understand what's going on.
Absolutely. And to be honest, it's been a pullback that's definitely caught the eye of a lot of investors.
Yeah, no kidding.
We've seen the S&P 500 slip, around 10% since February.
Yeah, that's a big move.
It is, and it always raises questions about what's really driving it.
It does, but when you see a drop like that 10%, it can be a little scary, but we have to remember that things like this happen.
Oh, absolutely.
I was looking at some data from Capital Group, and they say that, we actually see declines like this of over 10% in the S&P 500 about every 18 months
Wow.
on average.
That's more often than I think most people realize.
It is. So it's not something we want to see,
Of course not.
but it is a normal
Yeah.
part of the market cycle.
It's part of the ride.
Yeah, and I think that historical context is really important to keep in mind.
It really is. It helps to normalize these events.
Yeah.
Now, in terms of what's next,
Yeah.
well, that's the big question everyone wants answered.
Right.
We are seeing some sentiment indicators like CNN's Fear and Greed Index flashing some pretty strong signals.
Oh, yeah.
It's actually at extreme fear right now,
Extreme fear. Wow.
which often hints that the market might be a bit oversold.
Okay, so oversold, what does that even mean?
Well, it basically means that the selling has been so strong that prices might have dropped more than what's really justified by the underlying fundamentals.
Okay, but you're saying even with all this fear, a quick bounce back isn't a sure thing?
Right. Markets rarely move in a straight line.
Yeah.
We often see these pop and drop patterns
Pop and drops. Okay.
where you get temporary bounces followed by more declines.
I see.
The market kind of tests its lows before it's ready to make a sustainable move higher.
It's like it's trying to find its footing.
Exactly.
Yeah, okay. And all of this, hasn't gone unnoticed by the big names in finance.
Oh, no.
And one person in particular who I think is worth paying attention to is Larry Fink.
Right, the CEO of Blackrock.
Exactly. And BlackRock manages something like $11.2 trillion in assets.
That's an incredible amount of money.
It is. So when he speaks, people listen.
Absolutely.
Mm-hmm.
His insights carry a lot of weight.
They do.
Because he's at the head of the world's largest asset manager. He's got this really unique perspective.
Yeah.
He sees the markets. He sees the big picture economy. It's all connected.
Right. And it's important to remember what was happening before this downturn.
Yeah.
I mean, the S&P 500 has had a couple of really strong years.
It has.
Like over 20% returns 2 years in a row.
That's impressive.
It is. And in 2024 alone, it gained 24%.
Wow.
So, we had this period of really significant growth.
We did.
And then we see this pullback.
Yeah, but, that strong performance kind of came with a price.
Right.
It pushed stock prices up faster than company earnings were growing.
So the valuations got a bit stretched.
Yeah, that's a good way to put it.
Okay.
And this led to what we call a high price-to-earnings ratio.
Okay, so for people who don't know, what's the price-to-earnings ratio all about?
It's basically a measure of how expensive a stock is compared to its earnings. Like imagine you're buying a rental property.
Yeah.
A high price-to-earnings ratio would be like paying a huge price for a house that doesn't bring in much rent right now.
No.
But you're betting on it to bring in more rent later.
Right. You're hoping for future growth.
Exactly.
Hmm.
And before this sell-off, the S&P 500's forward PE was over 22,
Okay.
which is quite a bit higher than its 10-year average of around 18.
That's a significant difference.
It is, so investors were really banking on those future earnings.
Oh, what was making them so optimistic?
Well, there were two main things.
Okay.
One was the excitement around AI.
Oh, yeah. AI is huge.
Huge. It's driving massive investments, especially in tech stocks.
Yeah.
Investors are betting on AI to revolutionize everything.
Right.
And a good example of this is the spending by the big cloud providers like Amazon, Microsoft, Google.
Yeah.
They're pouring billions into AI infrastructure.
It's mind-boggling the amount of money they're spending.
It is. Their combined capital expenditure went from $117 billion in 2023 to a whopping $191 billion last year.
Wow.
And a lot of that increase is specifically for AI.
So AI was a major driver.
Definitely.
What was the second thing?
The second thing was the anticipation of a friendlier Fed.
Okay, the Federal Reserve.
Right. They control interest rates.
Yeah.
And after they hiked rates aggressively in 2022 to fight inflation,
Yeah.
everyone was expecting them to start cutting rates.
Okay, and why is that a good thing?
Well, lower rates mean cheaper borrowing for companies.
Oh.
And when companies can borrow cheaply, they tend to invest more, hire more, grow more.
So it's good for the economy and good for stocks.
Exactly. And the Fed did cut rates
They did.
by a full percentage point in the last few months of the year.
Okay, so AI and hopes for a friendlier Fed. Those were the two big forces driving optimism.
Right. But then we started to see some cracks.
Oh no, what happened?
Well, on the inflation front, it wasn't as straightforward as everyone hoped.
Okay.
After showing signs of cooling down, the numbers started bouncing around.
So it wasn't a clear downward trend.
No, and in fact, we saw a jump from 2.4% in September to 2.8% in February.
That's not good.
No, it means the Fed might not be able to cut rates as much as they wanted.
Right, because they still have to worry about keeping inflation in check.
Exactly. And then there were concerns about AI spending.
Really?
Yeah, some analysts started to think that the massive growth we've seen might be peaking.
Okay, so the AI boom might be slowing down.
Possibly. The initial build-out of infrastructure has to slow down at some point.
Right.
So those two pillars of optimism started to look a little shaky.
Okay, and that's where Larry Fink comes in.
Right.
He's been pretty vocal about his concerns.
He is.
And because of Blackrock's size, he's really in touch with what's happening inside businesses.
Yeah, he's got a direct line to CEOs and all this economic data.
So what is he saying that has him worried in the short term?
His biggest worry is President Trump's tariffs.
Okay. The tariffs on goods from Mexico, Canada, China, steel, and aluminum.
Yeah, those tariffs.
Okay.
Fink says they're making CEOs nervous.
Really?
Yeah, he's been talking about this shift in their outlook.
Like they're more cautious now.
More than cautious. He actually said every CEO he talks to is starting to talk about a more fearful economy.
So he thinks these tariffs could really hurt economic growth.
That's his view.
Okay.
He even put some numbers on it.
Oh, yeah.
He said that while the recent 7% drop in the market might seem like a blip, he thinks there's a chance we could see another 8% drop.
Wow. That's a pretty specific prediction.
It is.
And a scary one.
It is. But he did have some good news.
Okay, good news. Tell me more.
Yeah, he doesn't think this downturn is going to last forever.
Okay.
He believes the damage will be short-term, especially if businesses can adapt to the new trade policies.
So it's like a period of adjustment.
Right.
Uh-huh.
And get this, he actually called this pullback a buying opportunity.
Really a buying opportunity.
Yeah, he's still bullish on America in the long run.
Okay, so short-term pain, but long-term optimism.
That seems to be his message.
So let's sum this up for our listeners.
Sure.
What are the key takeaways here?
Well, the main thing is we're in a stock market correction,
Okay.
which is never fun.
No.
But it's a normal part of the cycle.
Right.
And this correction seems to be driven by worries about inflation, the possibility of slower AI spending growth, and the impact of those tariffs.
And tariffs are a big concern for Larry Fink.
Absolutely.
But he doesn't think this is the start of some long-term crisis.
No, he sees it as a temporary setback.
Okay.
And he's actually optimistic about the future.
Right. He even thinks this dip could be a buying opportunity.
He does.
So, yeah, short-term volatility, but long-term potential.
That's the takeaway.
Okay, so here's a question for you, our listener.
Okay.
We've been talking about a lot of different forces at play here, right?
Yeah.
Technological advancements like AI, economic policies like tariffs, monetary policy from the Fed.
Right.
All these things are connected.
They are.
So what do you think, which one of these factors is going to have the biggest impact on the market in the coming months?
That's a good question.
It is. It's something to think about.
Definitely.
Because understanding these forces is key to navigating the market going forward.
I couldn't agree more.
All right, thanks for listening.
Thanks, everyone.